Hello and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It was a grim week last week, given the fact that we saw 15 lakh crore worth of market cap being wiped out last week. In fact, the Nifty shed somewhere around 2.5%. And the Nifty Bank Index, shed somewhere around 1.5%. The Nifty Mid Cap Index also, had a forgetful week, so to say. Almost 3% cut coming in on the Nifty Mid Cap Index, and the Small Cap Index as well was down somewhere around 3%. Of course, it was the worst drop that we have seen in the market over the last 4 months or so. Large caps, they suffered quite a bit. If you look at some of the top laggards for last week, the likes of Trent, Reliance Industries, HDFC Bank, all these counters shaved off as much as 6 to 9% last week. The mood has turned extremely sour. Of course, we had threats coming in from the US president as well that he will be imposing 500% tariff on India. That has also soured sentiment. And of course, we were expecting FII flows to return to the Indian market this year. That hasn't happened. In fact, so far this year, FIIs have net sold almost 12,000 crore so far this year. That has also, of course, played a vital role in the kind of sell-off that we saw in the market last week. In terms of the cues to watch out for this week, of course, earnings season will be on in full swing. In fact, officially kicks off today. Technology bellwether TCS reports numbers. HCL Tech also reports numbers after the market hours. DMart, however, reported numbers on Saturday, and numbers were fairly good. But it was the same store sales growth that came in at 5.6%, and that, according to some brokerages, was a disappointment. Reliance Industries, HDFC Bank, those were the top laggards, as I mentioned last week. These counters will also be in focus this week as well. As Reliance reports numbers on Friday, and the likes of HDFC Bank, ICICI Bank will be reporting numbers on Saturday. So yes, it will be an earnings heavy week. All these large cap names that I mentioned will be in focus. So that's something that one needs to watch out for. Also, geopolitical tensions are being ratcheted up in the Middle East, right? Iran protests, that has seen deaths of over 540 or thereabouts. That escalating tensions in Iran are also playing a vital role in oil prices rising further. In fact, Brent hit that $64 per barrel mark as well. But on the other hand, you have gold and silver extending their record run. In fact, gold hit a fresh record high as well. So yes, lots of factors to watch out for, both on the global and domestic front. But so far this year, it hasn't really been a good start for our markets. We did see a spurt when it comes to the last few days of 2025. In fact, 31st is when we saw a good rally, and that also extended into the 1st of January. But post that, especially last week, we've seen a major sell-off coming in, with the Nifty, in fact, breaking below crucial levels as well. But 25,700, that was also violated on the downside when it comes to the benchmark index. But lots to watch out for. We'll be taking stock of what to expect from the likes of TCS, HCL Tech. We'll also be talking about what brokerages are saying about DMart numbers. Lots of other stocks as well in focus, the likes of Lemon Tree. We'll touch upon that as well. And not to forget all your stock related queries. So if you have any queries on some of these newsmakers, do send them in to us. We will get them addressed as we discuss these stocks. And of course, your other stock queries will also be taken up. So don't worry about that as well. But before moving any further, quickly take a look at the top stories at this hour. US futures slide after the Department of Justice opened a criminal investigation into Federal Reserve Chairperson Jerome Powell. The move marks an escalation in US President Donald Trump's efforts to exert pressure on the central bank. But on Friday, we saw the S&P 500 clocking in a record close. In fact, it was a winning week for Wall Street last week. Meanwhile, this morning, Asian markets began the week on a positive note. However, Japanese markets are shut on account of a holiday. The GIFT Nifty was indicating a negative start for our markets. Crude oil prices extend gains as the market continues to factor in heightened geopolitical risks. Gold prices also rise over 1% amid rising geopolitical tensions and expectations of further US interest rate cuts. Lemon Tree Hotels approves a strategic reorganization of its business and announces a fresh investment by global private equity firm Warburg Pincus in its subsidiary Fleur Hotels. Warburg will acquire APG's entire 41% stake in Fleur Hotels through an investment of up to 960 crore rupees. The earnings season officially kicks off today with the IT bellwether TCS and HCL Tech set to report their third quarter numbers. TCS's dollar revenue is expected to rise 0.3% quarter on quarter, while HCL Tech's revenue is seen growing 2.7% sequentially. And SEBI Chairman Tuhin Kanta Pandey has indicated that the process of granting a no objection certificate for the NSE IPO is nearing completion. While stopping short of giving a definitive timeline, he said the process could be completed within this month. All right, we'll quickly bring on board our technical expert and discuss what the setup is looking like for this week after the kind of week we had last week. But very quickly, for the week, we snapped out of a 2-week gaining streak. Market posted its biggest weekly fall in 4 months. The mid-cap index fell in line with benchmarks, down over 2.5%. As I mentioned, 15 lakh crore worth of market cap gone in just a matter of a week. All indices were down. In fact, the cuts were as high as 6% for some of the sectoral indices. The Nifty Bank posted losses but relatively outperformed. It was down 1.5% vis-a-vis a 2.5% downtick on the Nifty for the week. Adani Enterprises, NTPC, Adani Ports, ICICI Bank, these were the top losers from the Nifty. In fact, if you look at Friday's session itself, we saw a 5th straight day of losses. So Monday through Friday, we saw the markets, ending with cuts. The Nifty dropped below the 25,700 mark. Market breadth was, firmly in favor of declines. Very poor at 1:4. That was the NSE advanced decline ratio. And over 20 Nifty stocks fell more than 1%, with 6 of them slipping over 2% on Friday. Metal stocks, they managed to gain amid a weak session. You had the likes of Nalco, Hindustan Zinc. Those were gaining. But if you look at the FNOQs as well, the Nifty put call ratio, in fact, slipped to 0.62 vis-a-vis 0.66 in the previous session. It was the lowest closing level for the Nifty put call ratio since December 18, 2024. And if you look at the fund flow picture, FIIs, as I mentioned, they continue to remain net sellers. So far this year, they've pulled out 12,000 crores. But on Friday, 3,700 crore worth of sell-off coming in from the FII community. DII net buying, or domestic investors continue to buy 5,600 crore worth of buying coming in equities in the cash market from domestic investors. SAIL and Saman Capital, these two should be on your radar, given the fact that these two will remain in the FNO ban today as well. Without any delay, let me bring on board Rajesh Palvia, Senior Vice President, Research Head, Technical and Derivative at Axis Securities. Rajesh, lovely chatting with you. 25,700 violated, 50 DMA has been taken out. What are the key supports? And after the kind of week we had last week, what is the setup looking like? Should one sell on rise here on? How are you looking at the market?
Yeah, good morning. So yeah, looking at the setup, yes, it's a sell on rise kind of setup for near term to short term perspective, as Nifty has broken all its near term, short term moving averages support area. Derivative data is clearly suggesting that there is a short built up in the data. FII's long short ratio also indicating that they are aggressively short, despite the market is already corrected so much in last couple of days. They have not reduced their short position. Still, they are adding up more short position. PCR, though PCR is in oversold trajectory, we have already broken 50-day moving average. Now the next major support is placed at around 100-day moving average, which is almost around 25,500, 550 zone. This is the next level to watch for in the continuation of this down move, as there is no as such sector leadership is visible in this kind of fall. Most of the sector have attracted supply pressure in the previous week, and the sector where we were seeing outperformance are also showing a sign of profit taking, as sentiment is very low at this juncture, and still investor traders are on back foot. So looking at the data setup, until the Nifty not able to take out about 25,850, 900 zone, sell on rise would be the strategy. Maybe we could see further lower level towards 25,500. If at all Nifty not able to hold these level, we could see further more lower level to open going forward. So still, it's a sell on rise. Bank Nifty has also attracted profit booking in last week. There is a bearish candle if we look at the weekly chart. And looking at the data setup now, Bank Nifty has also broken 20-day moving average. Now it's heading towards its 50-day moving average, which is placed at around 59,000. So that level needs to watch closely in today's session. If we able to hold 59,000 level, then some buying interest we could see. But looking at the overall sentiment and structure of market, we believe that 59,000 is also very challenging to hold. And if it breaks, then 58,600 would be the next level for Bank Nifty also. So both indices are looking weak for near term perspective. Sell on rise is the strategy till the higher level, which I mentioned, not taken out by the Nifty.
Okay, sell on rise should be the strategy, and of course the 50-day moving average crucial to watch out for the Nifty Bank Index. Banks will of course keep or continue hogging the limelight. We have the likes of ICICI Bank, HDFC Bank reporting numbers over the weekend. What would you do with these counters, especially with HDFC Bank, given the kind of rubbing it saw last week?
We have seen, HDFC Bank is continuously facing supply pressure at a higher level. 1,000 has acted as a, very steep resistance for any kind of attempt which we have experienced for this counter in recent past. Again, the kind of sell-off which we have observed in last week, almost 6.5% kind of cut we have seen in HDFC Bank. So majorly the FIIs supply pressure was in most of the large cap stocks, be it Reliance, be it HDFC Bank and other index stocks. So FI is clearly selling their large cap portfolio, and HDFC is one of that stock. Now HDFC is approaching towards its multiple support area, which is at around 920 900 zone, which is very important and crucial for this corrective move. Any breakdown below 900 can attract a more liquidation of position in HDFC Bank, and possibly down move can extend to 860 zone also. So Bank Nifty as well as HDFC Bank both are at crucial level now. Bank Nifty is approaching to 50-day moving average, and HDFC Bank is approaching to its multiple support area of 900. So these two factors needs to watch closely.
Okay, that was about banks. We talk about more stocks, IT, etc. that have been focused, but let's take stock of how things are shaping up when it comes to the markets. Of course, we did see some bit of a green tick at the start, but we've given up that. It was mild, very mild uptick, but that has been given up as well. 25,675. We remain below that 25,700 mark. 8 points down on the Nifty as we speak. Sensex down 50. 83,530 is where it's at. The mid cap index is attempting to stay in the green, but very very mild gains, 20-point uptick on the Nifty mid cap index, and as we speak that has also been given up. So yes, attempt at a mild pullback, but that has also given way. The Bank Nifty as well moving in tandem with the benchmarks. The Bank Nifty is at 59,180 or so, down 70 odd points. The advanced decline ratio, in favor of declines as today as well at the start itself. So let's see how things pan out. 2:3, that's the NSE advanced decline ratio at the current juncture. 736 advances to 1,044 declines. We'll wait for things to settle down, but now the Nifty has given up 25,650 as well. It's down 50 points as we speak. So yes, not looking at a great start to the week. Of course, it will be a week where earnings will dominate the headlines. But yes, things not looking all that great to start off. Let's take stock of some of the movers then on the headline indices. We'll talk about sectors in just a bit, but take a look at which are the stocks that are contributing towards to the downside when it comes to the Nifty. Bharat Electronics down 1.5%. Some of these hospital stocks, continue to see selling pressure. Max Healthcare, Apollo Hospital, these are down anywhere between 1 to 1.5%. Apollo Hospital, as I mentioned, yes, it's down 1.5%. Indigo was down on Friday as well. Today as well, it's down 1%. ICICI Bank, again, among losers. Adani Enterprises among the top laggards last week, extending selling pressure today as well. L&T, Eicher Motors, Reliance Industries, another 0.5% down on this stock. Of course, last week it was among the top laggards, and this week it reports its third quarter numbers on Friday as well. So that stock will be in focus. Infosys, Tech Mahindra, all of these counters are trading in the red as we speak. But Eternal was another one that was dominating the laggards list. HDFC Life, SBI Life, these are the top gainers, gaining anywhere between 1 to 2%. There was some life insurance data that came in, so of course stocks are reacting to that. The December life insurance data came out before market open. Strong growth on a strong base for Axis Max Life. SBI Life also managed to post strong growth on a strong base. The new business premium was up 19% for SBI Life on a year-on-year basis, and the retail annual premium equivalent was also up in excess of 20%. For ICICI Pru, however, the growth was fairly modest. For LIC as well, the growth was fairly strong on a favorable base. There, the new business premium grew almost 40%. So, all in all, some of these life insurers are reacting to that data. But for HDFC Life in particular, the growth was weak on a favorable base. New business premium was up 15%. And total APE was up somewhere around 11%. So, yes, these are some of the stocks that are reacting to the numbers. Quickly talk about some of these technology names, Rajesh. TCS, HCL Tech in particular, numbers are coming out today. Of course, 2025 wasn't great for IT names, but ever since they reported the second quarter numbers, we saw buying interest, but of late that seems to be fizzling out as well. On a 3-month basis, if you look at some of these IT names, they have done fairly well. I think TCS, I was looking at it, 10% up in the last 3 months, but that seems to be fizzling out. But before earnings, how would you be approaching these stocks? And I think we have a query also on our feed on whether or not it's the right time to get into a stock like TCS. That was from Anil Kumar. He wanted to know that. So, your thoughts on TCS and HCL Tech?
So, ahead of earning, still there is no as such positive sentiment on the technical front. Stock is still struggling to cross its near-term supply zone, which is at around 30 to 40, which is almost at 20-day moving average supply zone. So until the 30 to 50 not 40 not taken out on the higher side, the trend is still on the slightly weaker side. Though earnings are there, guidance is important. How they deliver their guidance going forward and what kind of earnings they are going to present, that will decide the major course of action for this counter. Looking at the near-term, short-term structure, 3180 is the crucial level to watch for. We are almost trading around those level. Any breakdown below 3180 can take this stock further lower, which is around 3140, even 3120 kind of zone. So that level needs to watch post earning. So 3180, if you're a trader, if you're buying here for to take some position ahead of earnings, the 3180 needs to keep as a stop loss. If I compare with HCL Tech, HCL Tech is holding strength. Still, structure is on the slightly better compared to TCS. And we have seen stock has shown some sort of buying action, and bottoming out sign is already placed in HCL Tech structure. Looking at the near-term, short-term structure for HCL, 1690 is the immediate hurdle. If any breakout happens above 1690, then rally can extend to 1750, 1760 also. Though stock is trading about to 20-day moving average. So if you are already long on HCL Tech, you can hold on with stop loss of 1630.
Okay, that's about some of these technology names, HCL Tech, TCS, etc. Keep that on your radar. Numbers will be coming out post-market hours today. But another set of strong numbers that came out over the weekend was DMart, and the stock is clearly reacting to it. Stock is up 3%. In fact, 2026 so far has been pretty okay for DMart, given the fact that it is somewhere around 4%. YTD. I mean, it's too early to really call it YTD, but nevertheless. This year has started on a good note for DMart. Numbers were fairly strong. It reported double-digit growth. Profit rose 17%. Revenue was up 14%. However, some brokerages have pointed out that the same-store sales growth slowed to 5.6%. That has kind of missed expectations according to some brokerages. Citi has, of course, retained a sell call with a target price of 3,150. What is the setup looking like? We have a query on this stock from Naveen as well, wants to know your thoughts post numbers on the stock. How are you looking at the stock? It is picking up traction. Any kind of targets that you would be working with, and is it a buy post numbers?
So after a fall of last 4 months, there is a sign of some recovery from the lower level for DMart. But still, if I look at the kind of recovery which we have seen, still not sufficient to, confirm the bottoming out sign. Until the stock not taken out 4,000 level on weekly closing basis, still there is a chances that stock may attract supply pressure at higher level. Though there is a positive reaction to the numbers, stock is holding about 20-day moving average. So those who have already bought at lower level should now trail stop loss at 3860, which is very important for this pullback. If it continues to trade above 3860, maybe we could see some more pullback towards 3940, even 3970 kind of zone, where again either one should review the structure or try to book some profit around 3970, because 4000 is the crucial level to watch for on the higher side for DMart. And the kind of volatility, the kind of sentiment which we are observing on the market is again difficult to continue further more pullback for the individual stock also.
Okay, that's about DMart, and 4000 will be a crucial level to watch out for. By the way, all the sectors are trading with cuts. The Nifty real estate index, in fact, taking the sharpest knock, 1.5%. It has had a forgetful year, 2025, and 2026 also not panning out to be great for the real estate index. PSU banks also among the top laggards. IT down 0.5%. Only the metal index is marginally in the green, but barely so. So not looking great when it comes to the market. But let's shift focus to some other stocks. I was talking about the life insurance companies. They are holding out in a weak market. Of course, I read out some of the data wherein some of the companies have reported strong growth on a favorable base. Which are the life insurance stocks that you like among SBI Life, HDFC Life, LIC, etc.? In fact, we have a query coming in from Komal Makecha on this group of stocks, particularly for HDFC Life and ICICI Pru. Wants to know whether it's ripe for long-term investment at the current juncture. How are you viewing this life insurance space? Any favorites, and should one look at these names on a long-term basis?
See, if I analyze all this life insurance company, the structure, if I go with the structure, the strong structure is of SBI Life. ICICI Pru is also showing sign of strength on the near-term, short-term chart. Stock is forming rounding bottom formation on daily chart. Breakout is awaited. Any decisive breakout above 700, 710 level on a weekly closing basis may attract more buying action, and then gradually stock can extend its gain towards 760, 780 also. So if you're already on the long side of trade for ICICI Pru, you can hold on, as overall SBI Life, HDFC Life, ICICI Pru, these three stocks especially are showing sign of strength on the near term, short term chart. And we believe that the kind of
Okay.
resilience which we are seeing in this counter are ready to give breakout once the market stabilized.
All right, that's the view on some of these life insurance names. Hope that answers your query, Kumal. But let's shift focus to more queries that are coming in now. Talking about Olectra Green Tech, this query is coming from Mohit. He holds shares at 1300. He wants to know what should be a good price to average. Stock is quoting at 1127. The stock has been under selling pressure, and of course his buy price is of course higher than the current price. He's making a fair bit of losses here. Wants to average. What would be the right price and time to do it?
I think stock is in again corrective mode. Again, we have seen that stock has attempted to recover from the lower trajectory, but stock is still moving in falling channel on weekly chart and not able to take out the supply zone of this falling channel, which was placed at around 1265 zone. So 1265, 1270 is the breakout level on the high side. In this corrective move, now stock is approaching towards its multiple support area towards 1080, which is immediate support area in this correction. I think if I analyze of last 3 4 days behavior, it's a stock is sulking, but not with a heavy volume. So maybe 1080 would be the next level. Keep close watch of those level. If it's able to defend this level, you can average out.
Okay, that's the view and that's the level, 1080. Keep that on your radar, and perhaps that's when you can average. Let's get in a query going from Swaraj as well. Swaraj Lunawat wants to know your thoughts on IDFC First Bank. This stock is down today, but in the last 1 year has been fairly good for this counter. It's rallied somewhere around 40% or thereabouts. Would you look at an IDFC First? In comparison to the other larger names that we discussed earlier on the show?
So I think if I compare with all other sectorial index also, so Bank Nifty is still holding the strength on short to medium term chart, and IDFC First Bank is also one of the stock from that pack is holding the strength, though there is profit taking because of sharp supply pressure is there across the board. But if I analyze the weekly chart, stock is moving in upsloping channel, which is a sign of sustained buying action. Though in this corrective move, 82, 81 is the important level to watch for. If stock able to defend these level, I think again stock may attract buying action, and then we could see resumption of uptrend for the counter. So follow the stop loss of 81 if you are already holding the position.
Okay, that's the view. Hope that answers your query, Swaraj. Let's take in a query from Shweta Naidu next. She's sent in a query on HBL Engineering, holding at 900 rupees. Wants to know whether it's a hold or sell. The stock is quoting at 859 or so. What should she do?
So again, stock is in corrective mode, but if I analyze the short to medium term structure, it's in positive trajectory. In correction, yes, stock can slide further to 810, which is the next support area for the counter for this corrective move. So keep stop loss of 810 if you are holding it, or closely watch that level. If it breaks, then try to exit. Because 810 is the important and crucial for this corrective move. On the higher side, 890 is the first supply zone. If it crosses those level, then we could see a higher trajectory towards 950, 1000 also. So overall structure is bullish, but in correction, maybe we could see further more slide towards 840, 810.
Okay, that's about HBL Engineering. Moving on to the next query, I spotted a query from Geetu Sandesh. Wants to know your thoughts on whether to look at Motherson Sumi Wiring or JSW Energy as a best buy at the current juncture. Both the stocks have not had a good run over the last 5 sessions at least. Motherson Sumi Wiring, I was checking, it's down 11% in the last 5 sessions, and JSW Energy 7%. But if one were to choose between the two, which one would you go for, and what are the levels that you'll be watching out for there?
So I think I'll go with JSW Energy. This stock is showing a sign of consolidation since last 5 6 months in a tight range. And looking at the consolidation, we believe that any breakout above 500, 510 can attract more buying action, and then we could see good rally towards 580, 600 zone also. So I think looking at the structure, JSW Energy structure is looking quite comfortable. So buy and accumulate here. Keep stop loss of 460.
Okay, JSW is the preferred pick, and stop loss of 460. That's what Rajesh is suggesting there. An interesting stock query I just spotted from KR Kohli, and he wants to know your thoughts on Rosell Texas. It's an engineering and manufacturing company for leading global OEMs. Was just looking at the charts. The stock has rallied 16% in the last 6 months, but I think it has come under a fair bit of selling pressure, and it has shed somewhere around 28 to 29% since 26th of November. Any thoughts? If you can check out this counter, he's bought it at 708. Wants to know whether he should exit or stay put. Making a loss here, the stock is quoting at 564 or so. Any thoughts here, Rajesh?
Stock is in corrective mode, and stock has broken the important support area also in this correction. 600 was the major support area for the counter, and break below 600 trend has turned on the bearish side for short to medium term also. Almost now stock is quoting at the next important support area of 550. So as he is already holding it, follow the stop loss of 550, 545. That's the important level to watch for in this correction. If at all stock able to defend 545, some pullback action we could see, but again 600 may act as a supply zone. So my advice would be, if you have bought it for short term perspective, so try to exit in pullback around 600, 620.
Okay, that's the view. Look at pullback towards 600, 620 to exit. That's the view on this stock. But Rajesh, I'm afraid that's about time. We have to discuss all the stocks and queries. Had quite a few other stocks also to discuss, the likes of Signature Global, because it has cut its guidance as well. And we'll talk about that later. But before I let you go, any recommendations for viewers this morning?
So it's very difficult market to go long in this volatility. But again, some of the short idea where we are focusing, Cummins India is already broken the 100-day moving average support area, and the kind of supply which we have seen in most of the capital goods stocks. I think Cummins India may go down further. Possible target towards 3960, 3920 we could see on that lower side. Short with stop loss of 4060. On the long side, as we discuss about ICICI Pru, that stock is looking attractive on the long side. One can look at this stock to go long for upside target of 710. On the downside, 680 needs to keep as a stop loss. And one banking stocks where we are focusing, where we could see some uptake, that is IndusInd Bank. In this kind of volatile market also, stock is trying to absorb all the supply pressure, and the way breakout has already taken out, breakout is already seen in the last couple of days. I think if it continues to trade above 870 zone, IndusInd Bank can give some pullback towards the 920, 930 zone. So one can focus here also. Once markets start recovering, I think IndusInd Bank could be a stock where one can buy on the current level.
Okay, those were the recommendations. Of course, as you rightly pointed out, highly volatile market, very difficult to spot ideas to go long. But nevertheless, I think Rajesh, that's why we consult with you, and that's why our viewers put their faith in you as you share your recommendations. Thanks a lot, Rajesh. As always, a pleasure chatting with you. Let's hope the week turns out to be better than what we saw last week. But this morning, things aren't looking all that pretty. Thanks a lot, Rajesh, for joining in.
Thank you.
Well, the cut has deepened. 25,600 has been taken out on the downside. 108 points down on the Nifty. Sensex down almost 400. The mid cap index down almost 0.7%, underperforming the benchmarks, and the breadth extremely poor, almost 1:5. That's the kind of pain that we are seeing in the broader end of the markets. Just about 469 advances to 2,200 declines. Things aren't looking all that pretty, and it's only getting worse from here. 110 or 120 point cut on the Nifty as we speak. Crucial levels being watched out for. 100 DMA, that was the next level to watch out for on the Nifty. And some technical experts have also said that now that we have broken 25,700 decisively on the downside, 25,400 on the downside cannot be ruled out either, and that's not great news. Of course, 2026 started on a good note, but we kind of couldn't really go through with the momentum, and that's why, of course, after the kind of week we had last week, this week also looks like we are heading the same way. But hopefully, that won't happen, given the fact that we'll have a lot of earnings to digest, and if there is some kind of good news there, perhaps that could revive the momentum in the market. But To understand the setup from here and what to watch out for from the third quarter earnings season, let me bring on board Anand K. Rathi, co-founder, Mira Money, joining in. Anand, I believe we are speaking for the first time this year. Wishing you a very, very happy new year, but investors and traders won't be really feeling happy at this juncture, given the kind of year it is turning out to be. Very early to really call it a year, so to say, but hasn't been a great start. We're looking at a risk of sentiment in the market. But if I take you back to September 2024, when we hit a record high last time, since then a lot has improved. Profits are better, the economic setup is much better, inflation is softer, rates are lower, yet the sentiment feels worse today. What is it that's holding the market back, and what is it that could turn the sentiment around?
Yeah, Happy New Year to you and all of your viewers, first of all. Yes, it's not turning out to be the best of the years, at least in terms of start. But in my belief, this is a part of investing. When you start investing in equity, you are bound to see volatility and reactions to any short-term news. And today, the reason why we are all, we are seeing lower levels in Nifty for the last 3, 4, 5 days is because markets don't like uncertainty. Given the geopolitical situation that we are in at this point in time, the markets are trying to digest the fact that this is going to be the new norm. And with that being said, they're just trying to say that, okay, how much can be the impact of this uncertainty on India, on let's say the currency, on the large cap, mid cap, small cap companies, and then they are reacting to it negatively. So market doesn't like uncertainty, and we have been going through a lot of uncertain periods, not domestically but internationally, for the last let's say 1.5 years or so. So starting with US Trump tariff and today geopolitical tensions, oil prices, India's relationship with Pakistan and Bangladesh. So a lot of uncertainties are there, and that's one of the reasons why markets have been reacting the way they are. And one thing definitely that can change, in my view, is one of the positive triggers definitely could be that, okay, US and India get into an FTA. They say the tariff is not 500% or 50%. It is going to be, let's say, 16% or 20% or so. That's one positive news that can stop the uncertainty and can give some bit of a positive trigger, in my view.
But do you think that will be pushed even further? Because, word was from government officials that in the first 3 months of 2026, perhaps by March, one would have expected some kind of deal coming through. But given what's been happening, last week, of course, we had that 500% figure also coming in. Do you think this gets pushed further down? And if that happens, all the positivity that was there around Nifty hitting 30,000, Sensex hitting 1 lakh, could that be in limbo? I mean, what is your sense?
In my view, if the tariff doesn't change for longer, I think people will stop giving it too much of an importance. To be honest, whether it is 50% or 500%, it doesn't matter to exporters, because at 50% itself, the business is unviable. So whether it is 50, 75, 100%, I don't think it's going to affect the business per se. But yes, the sentiment will definitely get hit for some time or so. But the longer it takes to get into an agreement with US, I think the lesser the impact of it will be on the market, because by then the market would say, okay, I know that the deal is not going to happen. It would have already reacted negatively to it. So it may not really bother if it is beyond March or April. Sensex or Nifty hitting, let's say, 30,000 is quite possible, primarily because, let's say, the earning season, as you mentioned, is kickstarting today, tomorrow. And we are expecting positive growth domestically. If you see globally, while things have been very volatile, there have been a lot of positives internally. I mean, let me give you a couple of figures, like, the fuel consumption in December has been at the highest. The e-way bill generation has been the highest, record high, I mean. And even the passenger vehicle, the automobile sales have been doing good. So internally, things are looking solid. So for an FPI or a FII to turn things around, let's say the valuations are decent and the earnings are better than expected, I think the short positions can soon get converted into long position, and which could also trigger the market up. And I think 30,000 Nifty is quite possible because of that.
Okay, so you're saying despite all the tariff gloom, 30,000 on the Nifty is still possible, even if the deal gets delayed by a bit. But of course, we are also in talks with other nations to ink trade deals with them. The likes of EU, of course, UK happened, and then German Chancellor is also here in India. So that of course talks are on. So but what is your sense? Do you think striking trade deals with other countries could at least look at plugging the gap? Marginally or substantially? How are you looking at that?
Yes, there could be shift of trade. US is our biggest export market, and unfortunately, that is getting affected. So we are looking at various options, like you mentioned, UK, France, Germany. EU is one of the zones that we are closely, tracking ourselves. But on the other side, on the flip side, this is going to piss off. So it is going to be, actually hurt the sentiments of US and India trade. So in my view, as long as the trade, there will be trade deals, but US cannot be so easily replaced by EU in a shorter period of time, and that will impact exporters. So, for someone who's asking what should I do with the money, I think we should be very clearly focused more on domestic than on export-oriented companies, because we don't see revival or the markets opening up very quickly for the other global markets.
Okay, all right, got your point. Of course, focus on domestic themes. We'll talk about themes in just a bit. But since the earnings season is upon us, just want to get in your overall expectations, because the last 5 to 6 quarters haven't really delivered much excitement. Kotak, of course, is penciling in Nifty EPS of around 1072 for FY26. Are you expecting any real fireworks from Q3 earnings, or would you expect it to be the same as the previous quarters, and perhaps Q4 onwards or even Q1 FY27 would be the time when the real excitement comes back? What is your sense?
We are looking at exciting times ahead for sure. Whatever the effort the government has put into, let's say, help the economy revive, I think that should show results. We have seen semblance of it already with let's say, a few positive sectors positively getting impacted, especially on the consumption side. So in my belief, let's say with IT coming in, and IT could also surprise with a couple of large deals going their way, or they may announce a better than earnings, better than expected revenue growth in my view. So the fireworks may not be coming through, but like what we saw in Q2 earnings, where the number of downgrades started reducing, I think the trend will continue this year also, which means that, especially large caps, in my view, will show positive earnings growth, which possibly could be a bit of a surprise for a lot of people who are expecting not so great growth at this point in time.
Okay, got your point. Fine, but what about IT? That's the most pertinent question to ask, because we have TCS reporting numbers today, HCL Tech as well. And, there'll be a lot, that will be awaited in terms of AI investments as well, right? Given the fact that TCS on its investor day back in December quantified its AI revenues for the first time. Would you expect others to start doing that as well? And what are your expectations when it comes to large cap IT, and which way are you tilted at the juncture? Would you look at mid caps, or would you prefer mid caps more than large caps?
I think the large cap IT companies are in a better position at this point in time to win deals, invest heavily in AI oriented investments, and also take the best revenue out of it. So in my view, being a little more on large cap IT company is better than being more on the mid and small cap. But having said that, mid and small cap companies in the IT space are also aggressively bidding. So some loss of large cap IT could well be the business growth for mid and small cap. So in general, we are overall positive on IT. May not be extremely positive, but at the price point that we are in, I think there could be positive surprises on the IT pack. AIPs will impact more on the large cap side. Large cap, let's say TCS, HCL could also say that, okay, we are generating the revenues from AI is already coming through. Mid cap is where you will see deals coming through, in my view. So net, it as a pack, IT looks good for the price at which it is trading and the business growth it is expecting.
Okay, that's about IT. But let's also talk about the telecom space. A lot of clarity has come by when it comes to Vodafone's AGR dues. they'll be paying somewhere around 1200 crores over the next few years, and it's much lower than what the market was anticipating. What's your take on the telecom space now? Would you be looking at the frontline telco names, or would you play it via the tower firms? And now that some clarity has emerged on the Vodafone front, would it change your thesis on the telecom space at all? What are your views?
Telecom, I think, is the most interesting space. Will continue to be a consistent compounder for the next maybe 3-4 years, surely, because the penetrations are good, and there's a lot more clarity, like you mentioned, especially around Vodafone ruling and things like that. So, in my view, instead of playing the secondary, like say the infrastructure plays on the telecom side, one is better off playing telecom straight away, the telecom players straight away. The reason is very simple. The ARPU at this point in time is still at the world's lowest, in my view. It should increase, and telecom is one of the spaces that you cannot avoid today in anybody's life. So as the ARPU increases, the revenue growth is going to be significant without impacting too much of the profit. So my view is it's a consistent compounder for the next 3-4 years, and one should continue holding and keep investing regularly in telecom firms, and the primary play and not the secondary play as much.
Okay, that's a view. Interesting take coming in on the telecom space. What about banks? What are you expecting from the third quarter earnings? Loan growth has improved, but where do you expect the outperform? Margin pressure, of course, continues for some of these private sector names. Which way will you be tilted towards when it comes to the financial space? Would you play it through small finance banks, PSU banks, mid-sized ones or large ones? How are you looking at the entire financial space, and any thoughts on where the outperformance will come by in the third quarter?
In my view, bank is one of the most exciting space for this year as well. We were very clear that in 2025, banks will outperform, and so is going to be for the year for 2026, at least looking at it at this point in time. Generally, while banks are one of the interesting space, but financial services in general, if you see insurance companies, mutual fund companies, I think they are also as a pack looking very good. In terms of outperformance, I think there is definitely going to be deposit pressure because the interest rates are low, and even we saw SBI going to the markets to borrow because the deposit growth has not been as significant as a credit growth. So that's going to be creating a little bit of a margin pressure. But the growth on the revenue is going to be good, especially due to credit growth. So in my view, if they can keep the cost lower, the deposit cost lower, I think that itself could show significant growth on banks, EPS, and then that can positively impact banks. So that is where the real differentiation could be. But as a pack, I think one should definitely look at insurance companies, mutual fund or AMCs, which are expected to show better than expected earnings growth going forward.
Okay, got your point. What about consumption? FMCG, autos, the GST tailwinds will flow through, and they were expected to flow through from the third quarter earnings. And if you look at the updates that have come in from some of these FMCG names, volumes have improved. So how are you looking at FMCG, autos? Do you think the GST tailwinds would accrue from this quarter itself, or would you wait for another quarter to see the numbers and then perhaps take a call on this space?
Especially on the FMCG front, I think rural consumption has picked up significantly, and that is contributing to volume growth. But I'm not really, very bullish on FMCG because the price at which it is trading is not really, as attractive as an auto play or a bank play or an IT play. While you may see revenue growth, you may see volume growth and bottom line growth, I think, if unless until there's a huge surprise in the revenue, I don't see a reason why one should be heavily invested in large scale FMCG companies. While auto, I think, can still continue its uptrend. But FMCG as a pack, I'm not really too positive about at this point in time for the price at which it is trading.
Okay, sure. Valuation wise, of course, FMCG commands much higher multiples, if you compare to the rest of the sectors. But let's talk about another pocket that has come under intense selling pressure. Some of these cap goods names like BHEL, Siemens Energy, they have been under severe pressure. Of course, there are reports that the government may ease curbs on Chinese firms bidding for government contracts. That has put a fair bit of pressure on some of these capital goods names. Your thoughts on this space? Have you looked at this news, and what could this entail?
In general, when you deal with the PSUs and government-oriented firms, anything around the budget is any news around budget, any news around the policy is something that will affect cap goods significantly. In my view, in general, one of the reasons why we avoid PSUs is because, one policy change somewhere can impact the company's revenue significantly. And then there are also margin pressures in general when they start bidding for larger projects. One is Chinese, allowing Chinese companies to build, infra and build things in India. That is one of the reasons. The other thing I think is this government, particularly after the third term, has shifted its focus away from, building to consumption. So they were initially looking at building infrastructures and highways and shipments and all this stuff, but they've realized that the middle class was under severe amount of pressure, so they moved away from to consumption, and the focus will continue, which means that there'll be lesser money for all these people to actually grow their build revenue from. So that's one of the reasons why I think they will continue to be under pressure, and one can maybe invest a little, but I don't see a reason why one should significantly go high on cap goods at this point in time.
Okay, not high on the list, capital goods as a theme, but how have you been navigating this leg of the sell-off in the market, this kind of volatility that we are witnessing in the market? Any sectors that you have rotated into? Some of these new age firms have been under selling pressure recently. Would you look at that as a buying opportunity? Any other sectors where you have rotated into, and any sectors that are complete avoid at the current juncture?
There is no avoid, but yeah, you can actually not really go really high even at this point in time as small cap companies, because we believe that even if there's an earnings revival, it is going to come in large caps and not going to come in so early at this point in time in small caps. So one can avoid or focus a little less on small cap, because at this point in time it looks risky. But we have been very clear since 2024, the area of focus for us is going to be large caps. We have had 90% of our money in large caps and 10% in mid caps. I think we'll continue with that strategy, and let's say if the selling becomes immense in small caps, maybe at that point in time is when we may look at systematic investments in small cap companies. At this point in time, it's a clear avoid according to us. Market volatility is expected. It is down 2.5% since the beginning of this year. Just assume that your portfolio is going to be down 5%, 5-6% at any given point in time. Do not stop your SIPs, do not stop your investment at this point in time, because these are the times when you look back, you will see better returns in next 3 years, 4 years, 5 years. So you shouldn't miss these opportunities. Yes, it's going to give a little bit of a goosebumps, some bit of a problem in your belly, in my view. But this is a part of investing in equity. So invest a little higher on large caps and some bit on mid cap is what we are doing for our investors, and we'll continue this way for some more time.
Okay. Looking at the screen, it does give you goosebumps, because 25,600, of course, was violated today, and it's the 6th straight day of losses coming in for the market. So yes, one would get goosebumps looking at the screens. But what about the rally in gold? If you particularly talk about it from compare it with the equity returns, the Nifty to gold ratio has slipped to just under 2. And now this level historically signals peak risk off sentiment. Does this suggest that fear is close to peaking, or is the market still bracing for more downside from here? How are you looking at this Nifty to gold ratio, and what is your sense when you talk about precious metals as a basket? Silver, gold, and given the kind of geopolitical tensions that are brewing in the Middle East, doesn't seem like it's going to stop anytime soon. So, would you say that one has still not missed the rally in gold and silver?
So, like the way equity doesn't like uncertainty, gold loves uncertainty. So, I think during these times, maybe another till the time things look like they settle, I think gold will continue to be the darling of the market. one can continue to be invested and keep investing on a regular basis into gold is what our belief is, but don't really go very high on it. Maybe at max 15-20%. 20% itself is a very high number in gold, because what happens is during these times it does well, and if you don't look at opportunities to exit gold in the longer run, it ends up becoming similar to equity or so. So yes, I think it's going to be a tale of two halves. First half is going to be the year for gold, and the second half would possibly be when the uncertainty reduces, gold could stabilize, and then equity markets could actually pick up when the risk of trade starts. So the gold silver ratio, sorry, the Nifty silver or Nifty gold ratio is also pointing out to reducing the allocation, which I strongly believe one should do. But maybe they can wait for another 3 months, another 6 months before they start trimming down their positions both in gold and silver.
Okay, but between gold and silver, since you mentioned gold, silver, I'm tempted to ask you this question, because silver tends to be even more volatile, right? Recently we saw, silver prices crashing quite a bit in one day. In fact, it saw its worst single day drop in 4 years. That's the kind of volatility silver entails. So between gold and silver, if you talk about, an asset class that can create wealth, would you lean more towards gold? Is that the thesis?
Yes, gold is more of a structural call where it should be a part of your portfolio at any given point in time, whether it's 5% to 15% is a call that you should take. But silver is more of a tactical asset. You should buy it, hold it for some time, and possibly at a certain point in time when the rally is kicked in and given enough and more returns, look at trimming silver, because silver is more industrial than a reserve currency. But having a little bit more in silver, because it's becoming more and more a part of the strategic asset of a lot of these nations, and treasury is good news for silver. So if it was, let's say, 3-4 years back, gold was the only asset. Today even silver is considered. So maybe split 70-30% kind of a ratio, where 70% of your money is in gold and 30% is in silver, and that becomes a part of your structural asset, and some tactical assets into silver is what we should play for.
All right, that is a construct when it comes to precious metals. But rest of the portfolios, how would you construct it in such times, in such volatile times?
As I mentioned, so we have 4 assets that we can focus on. One is primarily Indian equity. Second is global equity, because we all know that in general, INR depreciates by about 3.5%, 4% every year. So one can look at about 20% of the money in global assets. And the remaining, let's say 10%, can be split between precious metals and some bit of debt. But in general, we suggest 70-20-10 is what one should approach investing with. And in the 70% equity, one should look at 90% of their money in large caps and 10% in mid caps at this point in time if you're starting new, and slowly add small cap if there's an opportunity available going forward.
All right, that's the view, and that's how the portfolio construction should look like in such volatile times. With that, Anand, would like to thank you for taking out time and joining in. Always a pleasure. Let's hope the red that we see on the screen changes soon and quickly, because then of course looking at the screen it does give us butterflies in the stomach. But hopefully things will change as earnings start trickling in, and we get more domestic focus, because of obviously globally a lot of uncertainty looms large. But thanks a lot for joining in this morning.
Thank you.
Well, that we just come to the end of the show, but leaving you with the triple-digit cut on the screen when it comes to the Nifty 120-point cut, 25,560. That's where we are at. Sensex down almost 450. The mid-cap index underperforming, down almost 0.7%. Breadth has improved marginally, but nothing really to boast about. 1:4 almost. That's the NSE advanced decline ratio. 574 advances to 2,200 declines. Some of these companies that have come out with their quarterly updates, the likes of Signature Global, taking it on the chin. Signature Global is down 6% or so. It has cut its guidance. Aside of that, the laggards list is fairly long today. Quite a few of them, dominated by the likes of Max Health, Apollo Hospitals, Eicher Motors. Adani Twins continue to feel the pressure. Reliance Industries down almost 1% now. So yes, not looking all that great. And if you look at some of the mid cap movers on the downside on the Nifty 500, you have stocks like Tejas Networks are down 8%, Signature Global, as I mentioned, down 6%, Maharashtra Scooters down in excess of 5%. These cap goods names continue to sell off on on the possibility of the government easing curbs on Chinese firms. BHEL is down another 5%. Even Siemens Energy was down almost 3 to 4% last time I checked. Other names like Divi's Lab, Ipca Labs, these also down in excess of 3%. Laurus Labs, all these CDMO players are down. Radico, that's also among the laggards. Let's also look at some of the green, the stocks that are flashing green. Manappuram Finance, that stock is up almost 4%. That stock was down on Friday on certain news flow with regards to Bain Capital, but that stock is up today, up almost 4%. Premier Energies, that stock is down 3.5%. Vari Energies, that stock is up 3%. Hindustan Zinc up 2.5%, and DMart post good numbers. The stock is up 2.5%. Although some brokerages have flagged off weakness in same store sales growth, but nevertheless the numbers are fairly good and the stock seems to be taking it pretty positively. Hindustan Copper also is among the gainers as precious metal prices continue to rally. BSE is the other one that I want to point out, that's up somewhere around 2%. But all in all, markets not looking all that great, but let's see what second half has in store for us. First half not panning out to be all that great. With that, completely timed out on this edition of Opening Bell. I'll see you at 3 p.m. with closing bell, and of course we have big ticket earnings trickling in post market hours. We'll take stock of that as well. But till then, you guys stay tuned to Money Control for all your news and updates. I'll see you soon and have a great day.